Have you wondered about the relationship between levered company and unlevered enterprise ratios? In this video, we look at levered and unlevered price-to-book ratios. Ratios of listed companies published in the financial media or supplied by the major providers of financial information are usually levered or company ratios. For example, price-to-book ratios are usually based on the listed share price of a firm's equity, the P, and the firm's net tangible assets per share, the B. A firm's net tangible assets will include both operating and financial assets and liabilities. Levered ratios include the effects of both the operating and financial activities of a firm. This means they can be influenced by changes in a firm's financial activities, even if there is no change in a firm's operating activities. For this reason, we need to be careful about interpreting levered ratios. We can express levered and unlevered price-to-book ratios as levered price-to-book ratio equals market value of equity divided by book value of equity, and unlevered price-to-book ratio equals value of net operating assets divided by the book value of net operating assets. The levered price-to-book ratio is the relationship between the market value of equity and the book value of equity. We know a firm's levered price-to-book ratio can be changed through changes in financial leverage. It is in part determined by how a firm's operations are financed. The unlevered price-to-book ratio is the relationship between the value of a firm's operations, that is the value of its net operating assets, and the book value of its net operating assets. This cannot be changed through changes in a firm's financial leverage. It will be unaffected by how a firm's operations are financed. The relationship between a firm's levered and unlevered price-to-book ratios can be expressed like this. A firm's levered price-to-book ratio equals its unlevered price-to-book ratio plus the effect of financial leverage. In other words, a firm's unlevered price-to-book ratio is its levered price-to-book ratio with the effect of financial leverage removed. If we think a firm's financial leverage does not affect value to equity investors, then a firm's unlevered price-to-book ratio will give a clearer indication of the relationship between market and book values for a firm than will its levered price-to-book ratio. A firm's levered price-to-book ratio will equal its unlevered price-to-book ratio when it has no financial leverage, that is, financial leverage equals 0, or where its unlevered price-to-book ratio equals 1. If the book value of a firm's net operating assets does not accurately reflect the value of a firm's net operating assets, that is, unlevered price-to-book ratio does not equal 1, as is usually the case, and if the firm has some financial leverage, which is also usually the case, then a firm's levered and unlevered price-to-book ratios will be different. For further information on levered and unlevered ratios, go back to Chapter 6, Section 6.4 in the study guide, and also review Focus on the Enterprise weekly questions. Also answer, write and rate questions on Focus on the Enterprise in Peerwise.